Imagine you are on a deserted island and you come across another human being for the first time in your life. You both need some bananas and you both have fishing rods, but that's all. So you say, "Hey, I'll give you my fishing rod for 2 bunches of bananas." And he says, "Great, deal." Now this is called barter. It's the most primitive form of exchange. You trade one good for another. But what if you had something better like an axe? You couldn't just trade it for 2 bunches of bananas because maybe they aren't worth that much, right? That's when money came in handy. All of a sudden you could trade your extra axe for some money and use that money to buy as many bunches of bananas as you want. Money is basically anything that people generally accept as a form of payment for goods and services and as a measure of value. Over the centuries, many things have served as money. The first commodity used as money was livestock. In Mesopotamia, around 3000 BC, the shekel became the first standardized unit of currency, made out of silver. Then, during the Middle Ages, gold and silver coins were widely accepted throughout Europe. However, with the Industrial Revolution, paper money started to become more popular because it was easier to transport than heavy sacks of coins. Eventually, we came up with the idea of a central bank that would oversee and control the production of money to make sure there isn't too much or too little. Nowadays, most countries use fiat currency, which isn't necessarily backed by any commodity. Instead, its value is fiat, or decreed by the government that issued it. For example, if the government of Zimbabwe decreed that a $100 trillion bill is equivalent to $1, then that's what it would be worth. But is this the future of money? In the digital age where everything is online and innovation is moving faster than ever, maybe it's time for the next evolution of money. Enter cryptocurrency. Decentralized digital currencies protected by cryptography that are nearly impossible to fake. The first and still most famous cryptocurrency is Bitcoin, a digital asset and means of exchange created in 2009 that relies on a distributed network of computers to record transactions in multiple locations, making it nearly tamper-proof. Bitcoin is not issued by a central authority and operates independently of banks and other financial institutions. Instead, transactions are verified by network nodes through cryptography, and users can transact directly with each other without going through a financial institution. Users can also anonymously purchase goods and services with Bitcoin without giving up their personal information. As of May 2021, Bitcoin is trading at about $56,000 per coin. That's about 13 times more than its value 1 year ago. And since there will only ever be 21 million Bitcoins, they are getting more scarce and therefore more expensive every day. Sometime around 2013, people started mining Bitcoins. That is using their computers to solve complicated math problems that help validate Bitcoin transactions and create new Bitcoin. This is how new currency is created and added to circulation. But here's the thing. The more people who join the Bitcoin network, the harder it becomes to solve these math problems because the competition increases. That's why the reward for mining Bitcoin is cut in half every 4 years. Currently, miners get 6.25 Bitcoins for each block they validate. But starting in 2024, that reward will be cut in half to 3.125 Bitcoins. At the current price, that's about $176,000 worth of Bitcoin per block. So unless the price of Bitcoin doubles, mining won't be profitable anymore. Now, before we talk about the future of money, let's talk about the history of credit cards. They were invented in the early 1900s as a way for businesses to sell more stuff. People quickly realized, though, that they didn't need to carry around lots of cash to make purchases. They could just charge everything and pay for it later. Banks loved this idea because now they could loan out people's money to them and make tons of profit. Of course, the catch is that you don't get to borrow money for free. The bank charges interest on the loan. This interest rate varies from person to person depending on their credit score. The higher your credit score, the lower the interest rate. But it's important to know that not all credit cards work the same way. Some of them require you to pay off your balance in full every month, while others allow you to carry a balance over month after month. If you do that, though, you'll probably pay thousands of dollars in interest. Now fast forward to 2004, when someone wanted to buy something online but didn't want to give away their credit card number over the internet. That's when PayPal was born. It was supposed to be a safer alternative to credit cards. Instead of giving away your credit card number to a merchant, you could just send your money to them through PayPal. A few years later, people realized they could use PayPal to transfer money between each other without even having a PayPal account. All they needed was an email address. That's why today you can send money to anyone in the world within seconds with very little fees. But PayPal isn't the only option. There are plenty of alternatives like Venmo, Zelle, Cash App, and more. They all operate in much the same way. But what does the future of money look like? Well, if you ask JP Morgan, they predict that money will become completely digital. According to their research, the average consumer won't even notice this change because they already do most of their banking on their phones anyway. Digital money will just make that experience a little bit better. On the other hand, big corporations might prefer to pay each other in central bank digital currencies, CBDCs. These are state-issued digital currencies that are backed by the government and available to everyone in the country. The main benefit of CBDCs is that they could make transactions faster, cheaper, and more secure. And unlike cryptocurrencies, they'll be subject to capital controls, meaning the government could easily restrict how, where, and when you use them. For example, they could force you to spend your money only at local businesses or prevent you from buying certain things with it. The possibilities are really endless. And even though 14% of Americans are already unbanked, meaning they don't have access to a traditional bank account, the rest of us might eventually be forced to switch to digital money. But what about cryptocurrencies like Bitcoin? Are they the future of money? Well, maybe. Just last year, El Salvador became the first country in the world to adopt Bitcoin as legal tender alongside the US dollar. The president of El Salvador believes that adopting Bitcoin will make it easier for the country's 2 million strong diaspora to send money back home. He also thinks that it'll attract foreign investment and make the country's economy more resilient to natural disasters and pandemics. However, the International Monetary Fund warns that making Bitcoin legal tender could pose substantial risks to financial integrity, financial stability, and consumer protection. It could also complicate the country's monetary policy, capital flows, and exchange rate arrangements. Plus, a lot of people in the country don't even know what Bitcoin is, let alone how to use it. Still, if you ask some of the biggest names in finance like hedge fund manager Bill Ackman or billionaire investor Mike Novogratz, they think Bitcoin is here to stay. The question is, will it eventually replace fiat currencies? Only time will tell. The fact is, technology is changing our world faster than ever. And with 5G and AI, who knows what the future holds? Maybe you'll be able to buy a banana with your Bitcoin, Axie Infinity token. Who knows? Thank you for watching. If you enjoyed this video, you might also like another one where I talk about how the richest people in the world make their money. Thanks again for watching, and see you in the next one.